Hi, I wanted to give you a key to essential question number 4, version 1 from the fall of 2012. This question is about getting a brand new pressure washer and spending $10,000 on it. That's a piece of data. That's a purchase we're going to make. The washer is more energy efficient than the previous one, so it's something that's supposed to save you $1,000 per year on water and gas. So we're actually looking at that as a change in operating expenses, and we're supposed to analyze the cash flow and purchases 1 through 3, and then we don't have to do anything with selling the pressure washer in year 3. This is actually to make things a lot easier for you. When this was given in class, what was going on is that I issued a verbal that this was supposed to be a 5-year asset. So let's go ahead and take a look at how this played out in the income and cash flow statement. And this is the same spreadsheet that you have on the wiki. So we have what's going on in years 1, 2, and 3. And here is how we handle the reduction in operating expenses. So it doesn't show up as extra revenue. What it does is it shows up as a reduction, $1,000 in each year in the operating expenses. So remember, what we're looking at is this difference in the state of the world when we do versus when we do not have this new pressure washer. And so what we're saying is that the operating expenses were $1,000 lower in each of these years, and that's how you should be representing it. Now that audible about them being a 5-year asset comes into place right here when we're calculating depreciation. Recall that when we were messing around with this, we said we had a $10,000 washer. We said it was a 5-year asset right here. And so the first year's depreciation should be just 20% times this 10,000. The next year should be 32% times this 10,000. And the next year should be 19.2% times this $10,000. So if you go over to the depreciation schedule over here, sure enough, what we have is 20% of $10,000, $2,000, 32% of $10,000, and 19.2% right there. In order to get to this taxable income, you have to remember the sign convention is a little bit weird. So what you're supposed to do is take a change here and then subtract the operating cost change, subtract the depreciation change, subtract the interest change to get to this taxable income. So it's 0 minus a minus $1,000 minus $2,000, and that's how you get that $1,000 right there. And the same procedure works in order to get these values. Tax for us is treated pretty simply. All we're doing is taking the taxable income that's right there, multiplying it by 0.4, and that's how we're getting the tax in each one of these years. Now please note that the negative sign in front of each of these means that your taxes are going to be lower because of these things. Remember, we're only analyzing the change in reality because we're getting this brand new pressure washer. Then all you have to do is take that taxable income, subtract the tax again, so it's 1,000 minus a minus 400, and that's what gives us the negative 600 right there. And so the same procedure falls in each of these cases. The cash flow statement, at the top of it, is just kind of repetition of things that you've already did. So in each case, you're taking the net income and just transferring it right down. And then what you're doing is you're going back and you're grabbing the depreciation that you had already put in the income statement and transferring it back down too. And the reason is that depreciation is just that wacky expense that, is not a check that you didn't write to anybody. So while it is an expense, you still have the cash on hand, so we add it back in. Now, we had no changes in working capital. That's a different kind of problem, and all we have to really do is put in this change in cash because we've actually purchased the pressure washer. Sorry. That shows up in the investment section. That's something you should know from the first module of this course. And because we are reducing our cash in order to get it, it will be a negative sign right there. Now, we can go down to the bottom to get to net cash flow in each of these years. And all you're doing is adding all these guys up. The only thing that's a little bit funny is the gains tax. So what you're doing is taking negative 600 plus 2,000 minus 10,000 in order to get the net cash flow in that first year. And you're doing similar things over in years 2 and 3. So what I've done here is actually gotten to that last part of the question, which is checking to see is this a good idea or not. And what I've done is calculated the present worth of this net cash flow right here. So all this is calculated at 5%. It's minus 8,600 plus $1,880 divided by 1.05, and then positive $368 divided by 1.05 squared. And that should give you this negative present worth, which suggests that this is a bad investment. So again, here is a talk through of the answer to essential question number 4, version number 1 from the fall of 2012. Thank you.